Welcome to the Upside Journal podcast. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet, a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable, counter-cyclical returns in AI and climate tech. Today, we're breaking down the hidden alpha traditional funds are missing.
All right, let's dive right into the data. If you go out and ask exactly how much venture capital African startups raised in the first half of 2026, you're going to hit an immediate massive discrepancy. Brighter's tracking reports an aggressive $3.3 billion, literally a 10-year high. But then Tech Cabal reports just $1.44 billion. Think of this like a giant iceberg. That massive headline number is just what's visible above the surface, while the actual, gritty, institutional mechanics are completely hidden beneath. So, which number is the actual reality here? Well, the fascinating part is that this discrepancy isn't just sloppy tracking or some measurement error. Both of these numbers are technically correct based on their own parameters. Rather than looking at this as a mistake, we need to view this gap as the single most vital clue we have to understanding a fundamental shift on the continent. We've officially entered a tighter, highly complex era of capital composition.
That brings us to Act 1, the VC paradox of 2026, decoding the discrepancy.
To really unpack this paradox, we have to acknowledge that the era of growth at all costs is over, replaced entirely by capital discipline. This massive gap between our $3.3 billion and $1.44 billion figures comes down to three structural shifts. First, offshore incorporation is absolutely dominating right now. Entities primarily incorporated outside of Africa actually absorbed 50% of the funding value. Second, we're seeing a massive systemic scaling of debt financing. And third, extreme deal concentration. Capital is clustering fast. Just the top 30 startups took in 84% of all disclosed capital.
To put that consolidation into perspective, just look at this number, 235%. That represents the year-over-year increase in median deal size. The median check jumped from roughly $500,000 to a staggering $1.7 million. And let's be clear, this isn't because there's suddenly more money for everyone. Capital is actively retreating from early-stage risk and consolidating into much larger, heavily protected transactions.
And that right there is the true paradox. Total funding dollars appear to be up entirely because of a handful of mega deals, but the sheer volume of early-stage deals has plummeted by 21% to multi-year lows. Investors are strictly enforcing capital discipline, effectively prioritizing robust institutional infrastructure over those old vanity market share metrics. If a company hasn't proven its venture durability, it's just not getting funded.
Moving right along to Act 2, asymmetric information and talent verification, or as we call it, the flight to operational moats.
This current cycle is aggressively filtering out companies that previously survived entirely on subsidized expansion and easy credit. When that early-stage risk funding dries up, companies have to secure alternative exit pathways or they fail, period. That immense structural pressure is exactly why we hit this number, 63. That's the record number of mergers and acquisitions completed in just the first half of 2026, nearly double the previous year's total.
We're watching genuine systemic integration play out in real time. Just look at these massive moves. Flutterwave acquiring Mono, Paystack absorbing Brass, alongside some serious cross-border expansions. Viable exit pathways right now are being completely driven by trade buyers forcing industry consolidation. These larger incumbents are absorbing smaller regional operators who possess genuine operational moats to scale their own infrastructure.
And as you'd expect, this flight to safety is severely impacting the earliest stages. We are looking at a stark valley of death between angel checks and institutional venture capital. With only 190 total funded companies, which is a multi-year low, and a massive 44% decline in sub-$1 million seed rounds, the ecosystem is fundamentally starving early-stage risk.
Now, while the overall market is maturing, the data clearly shows that certain structural inequities are still firmly entrenched. We have to note the gender financing gap here. It persists sharply. Women-founded and mixed-gender teams secured a respectable 22% of the transaction volume, but they absorbed a mere 1.9% of the total capital deployed. It's a severe discrepancy between transaction volume and actual dollars, highlighting a huge pool of undercapitalized talent.
Let's pivot to Act 3, the climate tech supply chain edge, exploring the evolution of infrastructure.
For years, African VC was practically a synonym for early-stage fintech, right? Well, the ecosystem is structurally pivoting towards specialized energy solutions and digital identity infrastructure. And what absolutely jumps out in this shift is the sheer scale of the debt slice. Out of the capital tracked, a massive $614 million was debt financing. Founders are leaning on debt to avoid punishing equity dilution, while institutional investors are absolutely demanding the downside protection that debt provides.
Because we're seeing such a heavy reliance on debt, we really need to define the investment-grade terminology driving it all: securitization. This is the process of pooling various types of debt and selling them as consolidated financial instruments. It functions as asset-backed infrastructure. This shows us that climate tech is being financed much more like hard project finance than your traditional speculative venture equity.
The absolute best example of this, look no further than the electric mobility company Spiro. They recently closed a massive $270 million mega deal. Transactions like this, alongside Blank's recent moves, prove that investors want hard collateral and predictable revenues. They're effectively treating these assets as core economic rails, which has essentially pushed climate tech to funding parity with fintech, a real game changer.
So how does all this reshuffling impact the big four geographies? It's super nuanced. Egypt actually leads the total funding rank, but that's driven heavily by those massive debt and EV megadeals we just talked about. But look closely at Nigeria. They actually dominate the pure venture equity rank. Meanwhile, historical heavyweights like Kenya are showing slowing momentum, and South Africa actually dropped below the $100 million mark for the half.
Which brings us to our final section, Act 4, the repeatable flywheel framework, the new institutional playbook.
In this tight, highly selective landscape, pitching unverified potential is totally over. If we unpack the current investor's playbook, we see three non-negotiable steps. First, companies must demonstrate a strict, undeniable path to profitability. Second, they have to build robust governance frameworks from day one. And third, they must achieve real, systemic integration into the continent's core economic rails.
It really all boils down to this reality. The market is funding fewer, larger, more mature companies, and structurally deprioritizing the earliest stage risk it was originally built to underwrite. The venture durability of 2026 relies entirely on following proof, not potential. Funding is now strictly indexed to actual institutional infrastructure and undeniable unit economics.
So in an era of intense capital consolidation, how will you identify the operational moats hiding beneath those massive headline numbers? Capital has become highly commoditized, but the infrastructure to execute high-trust, cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to the Upside Journal and join our membership communities. See you in the next Daily Drop.